Haney Farms has been producing and retailing certified seed since 1937. With a full line of cereals, corn, and canola, find us at haneyfarms.com. We're joined right now on realagriculture.com by David Watt. He is the Senior Fixed Income and Currency Strategist. Welcome this morning, David.
Good morning.
David, the dollar is, basically par. For a lot of Canadian farmers who are exporting agricultural products, obviously the dollar is very important to the profitability of their business. What do you kind of see as the next 3 months for the Canadian dollar?
Basically lingering around parity to a little bit above parity, so a stronger Canadian dollar overall. This is because we just looked at the backdrop for the Canadian economy. We're still doing much better than the United States. We're a bit of a soft patch right now, but still overall doing much better than the United States. And given the recovery we've had from the past recession and how low interest rates are, we just think the Bank of Canada is going to grow antsy with how low rates are. And even though they might not necessarily be eager to raise rates dramatically because of the strength of the Canadian dollar, we think that the economy is just going to force them into a situation where they have to continue to raise interest rates. Now, we don't see that necessarily happening until Q2, but we think that the market will begin to prepare for that through Q1, and as a result of that, the Canadian dollar will see some upward pressure.
So I guess from a Canadian business standpoint, do you see this kind of becoming the norm for 2011 as we're going to kind of stay where we are and just kind of lightly strengthen?
Yeah, we actually sort of see Canadian dollar above par through most of next year, and then later next year we actually see the U.S. dollar starting to make more of a comeback against the Canadian dollar as we start then talking about the Fed starting to tighten interest rates. It seems like a far away at the present time given what's going on in the United States, but we think through mid-year, through Q3 of next year, we will start seeing signs that the U.S. economy is in a stable rebound. The Fed will start going antsy with the stimulus, the low rates, the quantitative easing, and start setting the stage for starting to tighten, and as a result of that, the U.S. dollar will start to firm up against the Canadian dollar. But even then, we still see the Canadian dollar hovering around parity through 2011 and well into 2012.
Yeah, and I think it's interesting when you say the Canadian or the U.S. dollar will start to strengthen. There's been a lot of I watch 60 Minutes every week, and they ran a special on the weekend about talking about how some of the states are virtually broke. Some of the municipalities are running out of money. Like, what when you look at the U.S. economy, how do you view it?
A lot of uncertainties at the present time. Those issues that you're talking about are certainly fiscal issues. The one thing that the U.S. does have that Europe doesn't have is the states can still eventually have recourse to the U.S. government, and the U.S. government does have the facilities to be able to get some of these states through their problems. The one thing that we do see going on in the United States going forward, and this is going to play out not necessarily next year, but maybe 2012, 2013, when we start getting to the next presidential cycle, is going to be the fact that the U.S. economy, the debt deficit situation, is terrible, absolutely terrible in the United States. This is on the national scale, not just the state level. But the U.S. is still rated AAA, and once we get to the next presidential cycle, we'll start seeing more focus on the debt and deficits. Are they able to come out with a long-term plan to get their debt deficits under control? And then, again, that's 2012, 2013. We might see some pressure on the U.S. dollar. But we also know in the backdrop that in 1993, the U.S. raised taxes, and by 1998, 1999, we were talking about the Treasury market disappearing because the U.S. no longer needed cash. So we won't necessarily see that anytime soon, but that sort of makes credit agencies reticent to say cut or put the U.S. on negative watch because they do see, within the last 20 years that they did deal with debt deficit situations by raising taxes. It doesn't seem likely right now, but it does leave an impression on the credit rating agencies. And so, but again, that's a 2012, 2013 issue.
So when you look at the Canadian dollar, is it at par or going to push above par because of the strength of the Canadian economy, or more in relation to the weakness of the U.S. economy?
Partly it's the strength of the Canadian economy, but it's also what we refer to here as, I say, structural issues, like the soundness of our banking system, the fact that the federal government has got its finances in order and the plan to get the deficit to zero by 2015, whereas the U.S. is going to run deficits for at least the next decade. We also look at provinces have relatively reasonable financial situations. Ontario is a bit of a risk, but again, it's not the situation that we see going on in some of the EU periphery nations. So that's a strong positive for Canada. The regulatory environment in Canada is also a source of strength. So we didn't let the financial sector itself is strong. The regulatory environment is strong. The fiscal situation is strong. So in that regard, Canada looks very much like a safe haven, as opposed to a place where you want to get out of when turmoil starts to hit the rest of the world. That's going to be an important backdrop for the Canadian dollar going forward. But the largest driver of the Canadian dollar has been and will be going forward commodity prices, and to that extent, we tend to focus a lot on what's going on in China. And in that regard, I don't think you're going to see a weaker Canadian dollar on a sustained basis for a lengthy period of time.
Yeah, you mentioned the Canadian dollar being looked upon as a safe haven. I was going to ask you, in 2011, are institutional investors or traders looking at the Canadian dollar as a good trade or as almost like an investment because of these things like our relatively strengthened economy, safeness of our banking system, and so on and so forth?
They can't really disentangle them. Canada is seen by a number of, global reserve managers as a place that they want to have more exposure to. Because of the fiscal situation and those sorts of issues, they look at the U.S. backdrop and they get somewhat nervous. They look at the euro and they get somewhat nervous about whether or not the euro will exist in 5 years. So they turn to what are perceived to be now more safe havens, and that would be Canada. And we've seen foreign reserve managers have been heavy buyers of Canadian debt, and they've been heavy buyers of Canadian dollar debt, which is, again, a vote of confidence in the Canadian economy and the long-term prospects for Canada. And one of those things, when the market sees foreign reserve managers buying Canada, they want to buy Canada as well because it seems like that's where the flow is going. So you've got a number of things that work in together, and again, that situation when there's a great deal of uncertainty over, say, financial stability, fiscal stability in a number of nations, you start trying to carve out those niches that look like they don't have those issues that are weighing on their nations or those currencies, and Canada tends to be one of the few that comes up as a place to be when those issues are, say, making the headlines as opposed to back on page 30.
Very understandable. Last question. So for the next 6 months, what is RBC Capital Markets looking at as a range for the Canadian dollar?
Basically say 10, so somewhat above parity, so 102 to basically just below parity, so 99, 98.
Okay. David, thank you very much for joining us today, and hopefully we'll talk to you again soon in the future.
All right, you're welcome.